Welcome back to our conversation about how to calculate benefits. We're going to walk through the process that you might take to calculate benefits when you're thinking about a strategic initiative that increases income, or one that might save you some cost, or one that will improve a non-financial performance metric. We're going to start with increased income. Increased income calculation is fairly straightforward. Well, sort of. Revenue is simply price times quantity. Easy enough. Except for what should your price be and how might you calculate the quantity. We're going to lean on some concepts we talked about in prior modules to determine how to come up with revenue from a new product or service. Let's talk about quantity first. We'll begin with the total available market. For example, let's say you want to create a mobile phone app. You'd go to the CITA website. You can see the link in the research tips. There you can discover that there are about 336 million wireless subscribers, which is the number of active devices. Now, it's safe to say your app is not going to land on every one of those devices, but we can make an assumption that you could land on at least 1% of all active devices. That's 3.4 million sales. Not too bad. However, it's likely that they're not all going to come at once. Now, you can do this similar sort of research regardless of what your strategic initiative is. In a perfect world, you would go out and do market research and to get some idea of how many apps you could sell. Not only would that confirm your market share assumption, in this case 1%, but it could give you some information and some projections on both the price that you should charge and the quantity sold over time. Problem is, this type of research takes both time and money. If you're Google, Apple, or Facebook, you certainly have the resources to do that. But if you're a startup, probably not. So what do you do instead? Well, you can use Rogers' adoption of innovation curve that we covered in a previous module and use those percentages. Remember, the x-axis is time. So you're going to have to make some sort of assumptions with respect to time, like the innovators and early adopters will come in years 1 and 2 respectively. It may take an additional year to get the early majority, and that takes us through year 3. Then you might say the late majority will buy your app in years 4 and 5. And for the laggards, you may never get them, so in this case, we'll assume that we don't. Applying Rogers' adoption rates results in a table like this. It starts with the total market, applies our 1% market share to come up with the total quantity of 3.4 million applications sold. And then we take a look at how this works out over time. We use the adoption rate for innovators in year 1, and then the adoption rate for the early adopters in year 2, and then in year 3, we take a look at the early majority adoption rate and use that. And then in years 4 and 5, we split the adoption rate of 34% for the late majority and divide that evenly over 2 years. Now, note that the total apps sold does not come to 3.4 million sales because we never do get the laggards. This pattern should look familiar. It's the old friend, the S-curve. When you project quantity sold over time, you should expect an S-curve. Low adoption rate at first, followed by rapid growth, and then a leveling off. If you don't see an S-curve, then you might revisit your assumptions. There may be a case for linear growth, but be aware it's not typical. Now let's talk about price. Again, you can do market research to determine price and analyze supply and demand, spending money that if you are a startup, you may not have. What you can do is use the break-even formula to come up with price. We know the quantity, so all we have to do is rearrange the break-even formula and solve for price. We know the quantity in the first year. It's 89,913. And now let's say it takes $300,000 to develop the app. We'll talk about determining costs in a later module, but for our example, we'll use a fixed cost of $300,000 all in. And then let's say it costs 50 cents per app to push it to customers. That's our variable cost. We crunch our numbers and we come up with a price of $3.84. And we'll round up to $3.99 just because that's what everybody else seems to do. We can add price to our table and use it to calculate revenue and cumulative revenue. You can see revenue starts small, but over time we have a pretty good revenue stream. Now, keep in mind things do fall off after year 5. And as a result, it would be a good idea to invest some of that revenue that you earned on this app in the first 5 years on your next app so that you have a growing business. And that's how the game is played. And this is generally how we do calculate the benefit when we're focused on increasing income. We'll stop here. We'll pick it up in our next lecture where we'll talk about calculating benefits when cost savings is our objective.